Thanks for tuning in to NDTV Profit yet again, and just take a look at what's corrected a bit. I wonder if real estate as an index can be pulled up, because the markets are choppy and volatile with a 1% downtick or near 1% downtick on the index. But the BSE Realty Index is amongst the top losers and is down about 1.5%. So keep an eye out for that. Energy seems to have come off a little bit, you have to admit, in the session today. So that is also looking a bit choppy, if you will. Utilities down, power down 1.6%. So power as an index has cracked quite a bit. We don't have a single index in the green. That's the problem area, if you will. But specific pockets of strength or weakness being seen, more so that IT is not faring as badly as I would have thought after the TCS commentary. So that seems to be okay. And from amongst the Nifty, while a clutch of stocks are in the red, but there are some winners in trade, particularly ONGC, which is up, and the non-Nifty pocket has Telecom, which is active. Vodafone Idea is up 3% yet again in the session. Hindalco and some of the metal names also seem to be doing okay. Now, talking point. Today's talking point, thanks for tuning in. The case for a chat for the talking point show today is obviously about volatility and whether the geopolitical tensions will indeed raise the market volatility and what to do in a scenario like that. So that's first up on the screen. Of course, do the global PMIs moving up mean that metal prices could do well, and therefore does the metal universe become investable now? And of course, whether IT earnings are showing any signs of bottoming out, or is that some time away? This and more with Vaibhav Sanghavi, CEO of ASK Hedge Solutions, joins us right now on the show. Vaibhav, good having you. Thanks for taking the time out. I hope all is well. I just wonder, Vaibhav, if you're bracing yourself for heightened volatility with a downward bias or not quite, because while the situation erupted Saturday late night our time, it was contained within 24 hours as well, because the world seems to be not able to afford another geopolitical conflict.
Yeah, of course, Neeraj. I think nobody can or nobody wishes to have an elevated or escalated geopolitical conflict. But what we see from a global perspective and the way we see is it's currently an environment of a lot of contradictions. And why do I say that? Is because on one hand, when we see US and when we see Fed, I think the growth numbers from a US economic perspective at the same time in terms of inflations have been pretty strong. On the other hand, I think China is kind of fighting deflation and probably very lesser growth. Lastly, when we look at Europe as well, is where we are looking at a possibility where they would probably push for rate cuts probably ahead from than Fed, which generally wouldn't kind of happen. So all in all, there are a lot of contradictions. But to take a summary out of it is basically that the growth which the world was expecting to be having a very hard landing, I think that's gone out of the window. We are looking at economies much more resilient. Of course, these geopolitical conflicts, may affect some changes, but that is something we'll have to wait how that kind of impacts come about, whether this conflict kind of continues. And if that continues, then of course there would be some sizable impact on each of those kind of variables. So volatility, to answer your question, I think is going to stay a little elevated, both from a global perspective and local perspective as well.
Vaibhav, so here's a question then. Heightened volatility, higher commodity prices, typically negative for markets per se in a correlation basis. Are valuations not necessarily cheap, even if they are not very expensive on a forward multiple basis? Does this therefore lead for a higher case for sitting on a bit of cash if a portfolio can afford it?
I think, as a student of risk, we've always thought about, in a way that whenever there is a big binary event up the cards or up the sleeve, typically we as a fund from a long short perspective go, highly hedged. So either we take a big cash call, probably a good cash call, or go into an event kind of hedged to a great extent. Now that doesn't mean that everybody should be doing that, purely because we are a risk-adjusted return fund and we are kind of an absolute return oriented. But from a relative return mindset, it's difficult to take a call from a net cash perspective, purely because the amount of domestic inflow which has been there, have been very supportive of the market. And fit in case in terms of an example is the year of 2022, when actually we saw through the year outflow of close to about $20 billion from an FPI perspective. However, it was kind of completely absorbed by the local kind of inflow. So I would probably mention that, yes, of course, volatility is there for the next 3 to 4 months. If somebody has that appetite to kind of raise that volatility, stay invested. If not, probably some might kind of take some amount of money from the table.
Okay. Now, one part of this conversation or one part of this volatility is to try and figure out if somebody doesn't have to make the cash call, let's say Vaibhav, and is wanting to stay invested, does information technology, and I wonder if we've lost Vaibhav Sanghavi frame. In moments from now, we'll try and get it back. But Vaibhav, if you can hear me, my question is around IT. And, when I spoke to TCS, the commentary seemed to suggest that while they have confidence on margins, the confidence on growth is difficult to predict, even for large companies, and nobody's fault. It's just that the macro environment is such. Would you take a contra call here on information technology, defensive sector, consistently pays dividends, great cash flow, equity size consistently reducing due to buybacks? Does that become a great sector to look at, or not quite as yet?
Yeah, I think the way we would look at from an IT sector perspective, I think let's segregate or slice that sector into few elements. And first is basically the revenue growth, which is one of the most critical aspects, from their valuation parameters. Now, if you take 12 months ago, or when everybody was expecting that the growth is going to crash and interest rates are going to kind of move down, which has kind of not happened. And because of that crash in growth, probably there would be pressures on the IT revenue. Of course, in the intermediate period, we've seen the discretionary spend kind of getting some amount of pressure. But on overall deal bookings, I think we are very encouraged by how things have been kind of panning out. Now, that's on the revenue side where, as per expectations, I think there is a possibility of a scope of improvement, coming in the second half of FY25. Coming back to the margins, which is the other critical parameter on this, and the way we are looking is, of course, the subcontracting is something which we'll need to take a close watch on. But at the same time, I think the generative AI is probably kicking in some amount of efficiencies as well. We do not have the exact quantum in how much bips, but we may be seeing some amount, of efficiency getting in, which people are not kind of expecting. In fact, with AI coming in, people were expecting further revenue pressures, which is not kind of likely to happen. So all in all, probably there may be a case where on both these two parameters, both on the revenue and the margin, we may be seeing, we may be bottoming out probably in the next quarter or two, with the second half of FY25 much better. So probably I think there is a trade from a medium to long term perspective to start getting into the IT space.
Okay, well, metals are in focus today as the London Metal Exchange has now banned Russian metals. Aluminum surged in the last 24 hours, probably the best single day gain or the highest single day gain since maybe 1987 or thereabouts. Kanika is joining us to add some perspective on that. Kanika, good morning.
Good morning. Right. So LME has banned deliveries of Russian supplies, which was produced after midnight on Friday, and this is in response to US and UK sanctions. Now, these sanctions are mainly aimed to curb President Putin's ability to fund his war machine, and this is causing uncertainty in the commodities market. And concerns are arising over potential disruptions in supply chains and the increased volatility in metal prices. Now, market participants are expecting dramatic price movements with regard to this and about the impact on the ban of prices. And LME has also acknowledged a relatively large supply of Russian metal could flood into the on the exchange, and sanctions are expected to prompt discussions at the Global Copper Industries annual CESCO week gathering in Chile. Now, these US sanctions on trading Russian aluminum, copper and nickel may benefit Asian materials producers, and US and UK sanctions could solidify China as Moscow's primary buyer for key commodities. This ban is likely to drive Chinese imports higher, and Chinese imports of Russian aluminum have already hit their record levels, and this indicates a strategic shift in global trade dynamics as well.
Okay, Kanika, thanks for that. So that's the base case on metals. Vaibhav, just wondering if this being the base, does it in any fashion make metals an investable pocket? Because I hear murmurs of institutional money wanting to get itself parked in large metal companies in India as well. What's your sense?
I think for metals for us has always been a very tactical play in that, in the scheme of things where a lot of variables kind of affect them, especially from a global perspective. Now, here is a case where, because of a technical reason and because of sanctions, we are seeing a temporary kind of spurt into the base metal prices. We strongly believe that, metal prices on a secular basis, if they have to sustain or probably, look up, is two things. One, there can be either a cost push, or second, there has to be a robust economic growth on a global basis. Now, either of these two things is not something which we are currently witnessing. So you might see a tactical play coming about purely because the funds are probably underweight as well. So there is a possibility that on a temporary basis, because of these news headlines, we may see. But again, it's pure tactical play. I wouldn't merit, at this point in time, looking at whatever variables are available for more secular kind of run.
Sorry, Vaibhav, so just getting it clear, you are not betting on it for a secular run, right? Did I get that straight?
Absolutely.
Okay, great. Okay. So tactical call, maybe if you can play it well, is what Vaibhav Sanghavi believes you can, but otherwise for a secular run, at least they are not betting on it. Point well noted. We need to slip into a quick break. We back from a break, talk about some of the big movers of trade today and check Vaibhav Sanghavi if he's constructive on them or no. We've spoken about metals already, but some more. And of course, try and ask about the big question, whether the political season can bring about upheavals that usually accompany an election season. We'll try and talk about that on the other side. Stay tuned. Back with Talking Point right here on NDTV Profit. Now, Phillip Capital and some others too, but Phillip Capital in particular came out with a note which when they spoke about some of the beneficiaries based on what the BJP has released in its manifesto. The argument is simple. You widely expect the NDA and the BJP to come back to power, and therefore their vision of what they want to focus on would clearly get backing and therefore would clearly arguably see some bit of benefits there. So that note, by the way, has a clutch of sectors and stocks which benefit out of this. Vaibhav, I would love to know, I don't know if you've paid some attention to that or no, but the manifesto came out over the weekend on Sunday, I presume, and there was a lot of focus on the usual suspect areas as well, green energy, of course, being there, focus on infrastructure, railways, etc. Are these pockets that you would be constructive on? Incidentally, all of them are down in trade today.
No, of course. I think Neeraj, from a policy perspective, one thing we have seen, over the last 10 years, and what is something which we are seeing in terms of a continuation from a policy document or a manifesto as well, is the continued focus on the supply side. At the same time, with a vision of what we can probably achieve by 2047. Now, it's pretty much something very refreshing to see where, the political parties manifesto are looking at, 25 years hence, right? And the planning which accordingly goes into it. Now, having said that, when we talk about supply side, I think focus on PLI, Make in India, and structural reforms, on something like, sectors like defense, I think really makes us believe that this is a space to kind of continue staying with, along with renewables and in form of various kind of angles of renewables, right from solar, wind power, or probably effective use of energy in terms of biogas, or probably hydrogen, as well. So I think a lot of plays there, largely focused on supply side, is what we will probably focus on from a medium to long term perspective.
Okay. Amongst everything else, the consistent theme seems to be infrastructure, Vaibhav. So while you spoke about it briefly, just wondering, how do you dissect what to do in, because it's a very wide bucket. How do you dissect what to buy within that infrastructure pocket? Some from a tactical perspective, some from maybe a buy and hold for a period kind of perspective.
See, when we talk about infrastructure, right, we've always focused on the ancillaries which are likely to get benefited, or the suppliers who are likely to get benefited from that whole infrastructure boom. One, purely because from a business model perspective, I think we want to be on an asset light models. At the same time, companies which can have the effect of operating kind of leverage as well as you kickstart your higher sales, higher revenue, from your existing capacities. So those are the segments you ideally would want to focus on as compared to your very, very asset heavy, or somebody who is doing this kind of capex. Of course, those kind of capex, companies would eventually benefit, but there's a big gestation period in between, where that company would not be doing in terms of their profitability much. So in the initial leg, focus on those kind of second order beneficiaries, which can come across with a higher spend in terms of the infrastructure or probably capex. So that is how we would probably look at it.
Okay, so that's infrastructure. Now the other bucket which is active today is oil and gas. Everything from upstream oil to gas companies are active. Now one can probably assign a reason to upstream oil and ONGC in particular, because Jefferies has initiated coverage on a buy rating, the target price of 390. A quick detour to my colleague Mihika, who joins in with the key points of the note, and then we get in Vaibhav's view on the same. Mihika, good morning. What does Jefferies have to say?
Yes, it's initiated a coverage at a buy rating at a target price of 390 rupees, which implies a 47% upside to the previous close. Now, one is the prospective pricing for crude, a tight crude oil market, with the IEA also increasing its oil demand growth estimate for 2024 while reducing its supply estimate. Furthermore, the KG basin production of ONGC is not subject to the special additional excise duty, which helps in terms of pricing. Other gas reforms in the gas sector in terms of annual hikes of the ceiling price, the floor prices, and the new wells from the nomination fields being applicable to premium pricing will help the company. They've also estimated ONGC's domestic production to return to growth over FY24-26, and they've estimated a 3 and 6% production CAGR for crude and gas over FY24 and 26. They've also built in a 1% production hike for OVL, and this is assuming no resolution is met in terms of the Russian assets, which the company does plan to do in FY25. And lastly, they expect the net cash position of the balance sheet to improve, with free cash flow around 71,000 crores in FY24-26, and they also expect the net debt to equity ratio to fall from 0.32x to 0.16x over the same period.
Okay, Mihika, thanks for getting that perspective. Vaibhav, the oil price upticks, unpredictable, at best, but does upstream oil, because of the reasons that Jeffries would have mentioned or otherwise, does upstream oil become a sector that you would consider?
See, I think, from an oil and gas perspective, of course, oil upstream would kind of be, variable to what's happening from a geopolitical standpoint. But I think from a longer term perspective, and as we move towards, renewables or probably more focused economy from a gas perspective, I think, again, which kind of gets clubbed into, the highlights from the manifesto as well, is focus on PNG, focus on hydrogen. So those are the spaces where we would ideally look for opportunities going forward. As I mentioned, I mean, upstream from an ESG perspective, longer term reducing the carbon footprint perspective. Of course, tactically, it can pay you at this point in time because of what's happening from a geopolitical standpoint. But from a medium to long term, I think our bets would rather go into biofuels, gas, hydrogen, and so on and so forth.
Okay. Yeah. Okay. There is also, of course, a specific reason why the gas-based companies are active today. Section 11 directed, which means higher gas demand, and that could all be positive. Remember, a lot of brokerages viewers are also very constructive on Gas Authority of India, for example. So watch out for the upstream oil and gas. Actually, which brings me, Vaibhav, to one pocket, a fund which has got an option to go long, go short, sit on cash, etc. How constructive are you on PSUs? Because not just banks, which of course PSU banks have outperformed private banks since the start of COVID, maybe, but the other PSUs as well have kind of made wealth. A lot of people argue that now they are priced too much to perfection, don't leave any execution risks, premium on the table, etc. What's your thought?
No, absolutely right, Neeraj. I think while PSUs have rallied, they've done really well, created good amount of wealth. The valuations, the way they have been, I think the differential between a private company and a PSU company in terms of the valuation gap has diminished to a great extent. Now, having said that, I'm not saying that we should not be looking at in terms of constructive basis. The way we look at from an overall PSU basket is those companies who are beneficiaries of the structural reforms vis-a-vis your commodities or cyclical plays. The reform-oriented companies, which I did mention about earlier, is the PLI, Make in India, and something like a defense sector. Those are the places, or those are the companies from a PSU basket we would, love to have an exposure to, as compared to those which are purely cyclical and more driven by the commodity cycles. Are something which we would probably avoid. So clearly, while they have gone up, there are still opportunities which are actually, coming from the overall structural reforms which have kind of happened, and where the government is kind of focusing on, to create that kind of further supply side ease from an economic standpoint.
Okay, Vaibhav, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time this morning, and look forward to have you more often on the channel.
Thank you very much, Neeraj. Pleasure to be here.
Now the pleasure is ours, and viewers, thanks for tuning into this edition of The Talking Point.